Testing. Mic test. It's a good morning. Okay, good morning, Philips clients. We're going to start our webinar today. Okay, let's. Okay, first for today's webinar, we're going to talk about our market analysis as well as the top picks for the year. Okay, it's a good way to get started for this January. Okay, so since we guided last week as well as in December, right? We already had noted. Okay, now this is the S&P chart from last week. We already had noted that we had an extended uptrend, and we had guided that the odds of a meaningful correction will be this year, and probably the two correction periods would be February or end January, and the May-September time period. And we mentioned that February would be a minor one, followed by a major later on. So, well, and fundamentals suggest that meaningful correction should be bought. Okay, so since we've made this call based on what we saw in our breadth indicators and divergences, etc., fast forward to this week, and we do indeed have a sell-off in the S&P as of last week. Okay, and so this is where we are right now. So the price of the S&P right now is basically within our support target, okay, of 1775 to 1810, and that's exactly where we are now. So this is verified down cycle for end January. So our guidance is just a little bit early. I mean, the market correction started a little bit earlier than expected, but nevertheless, we did mention that we were overextended and due for a correction, and it has started. Okay, so what's going on at this point in time? Okay, on a short term, on a short term, at this point in time, probably there should be consolidation soon. Okay, why do I say that? Okay, let's go to this chart over here. Okay, let's ignore my pattern here in the as of now, but let's just look at these indicators down here, the VIX as well as the SPX A50R. So the SPX A50R is the breadth indicator that shows the number of stocks that are currently above versus below their 50-day moving average. Okay, so as you compare to other corrections within the last year, so for example, between mid-May here to July, this was a meaningful correction. This is one of them. Okay, and if you notice these meaningful correction periods, right? This is how I'll say the oversold region. Okay, and as you can see, we are almost getting there. Similarly, if you look at the VIX, which is a fear index, right? Okay, the fear index also shows that based on previous peaks of the corrections, right? This is the 20 is about where they were at, and we're almost there. Okay, so this tells me that although this is definitely a downtrend, okay, likely that as you get to these oversold levels, right, there should be a pause in the sell-off. Okay, so if there's going to be a pause in the sell-off, then the question is, if we consolidate here, then is it going to go further down, or will it actually recover and go up? Okay, so technically speaking, we need to wait until a signal is triggered by the breakage of this support line at 1775. If this support line actually breaks, right, the target is actually down here to 1725. Okay, if the price pattern sharply breaks above 1815, okay, then that actually invalidates the bearish thesis. Now, because based on our previous analysis, if you look at our analysis in December, okay, because we expect further weakness for middle of the year, okay, that likely there probably will be another down move. Okay, as to when it is, we're not sure yet, but May seems to be a good candidate. Okay, so I think there will be probably a bounce followed by a move here, but of course, in the end of the day, we look at these two support and resistance lines for a signal, either way. Okay, so this is just a chart of the Dow Jones, just for your reference. In case you want to know what a 5% retracement, 7%, and a 10% retracement is, these are your targets here. Okay, 15, 7, 15,700, 15,400, and 15,000 itself. Okay, I do not expect the present retracement to exceed 10%. Okay, it should be within this range. Now for the STI, just briefly, we won't talk very much about it because we're going to talk about 5 of our top picks today. So in the interest of time, I just want to mention that on the monthly chart, the STI does have a bearish sentiment to it, at least on the short term. Okay, this green line is the 10-month moving average, and I would say it's a practical, useful gauge for gauging the intermediate momentum. And as you can see that the price is actually underneath the 10-month moving average, and the 10-month average is also pointing downwards. Okay. At the same time, the monthly MACD had crossed actually back here in January, August, but more sensitive. Looking at the black line itself, which is actually MACD line, I will say that before you can have a meaningful reversal, if you're looking for the upside, at the very least, you should wait for the black line to actually turn up, at the very least, okay? And we haven't had that yet. So because we haven't had that yet, I'll say we don't have any clear signals for going long at this point in time, okay? So now, we want to reiterate that we don't believe a bear market has actually begun yet, okay? So this is probably weakness, correction within the bull market. At the same time, the STI is attractive on relative valuations, okay? Hence, because you have good relative valuations but a bear sentiment, right, we are in a stock picking environment. Okay, so meaning that you have to be very, very selective for what stocks you pick. And at the same time, if you're a trader, you can probably choose to wait a while for sentiment to improve, okay, if you want to time your trades. Okay, so that being said, on any meaningful correction, we like to talk about our top picks for the year. Okay, we think these are good candidates for accumulation when there's when there's meaningful corrections. Okay, so top pick is one is DBS. Okay, DBS will benefit basically from rising interest rates. Okay, so as interest rates rise, DBS is the key beneficiary with the highest proportion of cheap funding, meaning their current and supply, savings account deposits. So this gives them bigger exposure to the rising interest rates. Okay, for global pickup, okay, including industrials and computer cyclicals, these companies will benefit. Baostat, Keppel Corp, and Iconics. Baostat basically has a record high order book in energy, industrial design and build, undervalued with catalysts in potential REIT and Iskandar JV. For Keppel Corp, we have resilient O&M margins with efficiency gains, strong order wins, visibility till 2019, and with a strong dividend yield of 4.4%. For Iconics Brands, it's basically a free cash monster and benefits from the US economy strengthening with more consumers spending money. And for the cyclical trend play, we have M1, which benefits from data monetization on tiered plans and doubling access usage charges. Okay, so now we shall invite our analysts to talk about these key companies. So starting first, we have Benjamin, who will talk to us about DBS.
Hi, good morning, everyone. Hang on for a minute. Hi, testing. Is it on? Okay, good morning, everyone. My name is Benjamin. Today we just a quick run through on DBS Bank, which I've actually presented on during the last week of December, if you have tuned in. Okay, so a quick run through of the company snapshot for DBS. This closing price is as of last Thursday, but Friday's closing price was $16.67. Right, so our target price still stands at $19.09, right, with accumulate rating. So again, DBS has outperformed the STI over the last 1 year. Right, company overview. Net interest income for DBS for the 9 months FY13 stands around 61%, about 1 to 2% higher than its peers. Fees and commissions, about 21% of its total revenue. Okay, DBS, how is it fared so far? Right, strong and broad-based loans growth across the various loan mixes. As you can see over the last 3 years, and this continues to drive a strong growth momentum in their net interest income despite a low interest rate environment. All right. So for the fees and commission, which takes up 21%, again we see that it's gaining very healthy traction over the last 3 years, right? And it outperforms its peers in terms of the total fees and commission as well. Cost management is tight and efficient, right, ranging from about 41 to 45%. Okay, so 4 key investment merits to reiterate our pick for DBS in the Singapore banking sector. Number 1, DBS stands to benefit the most from the rising interest rates that we predict should kick in the medium term, i.e. FY14 onwards, and this should result in a net interest margin recovery, which should continue to drive their bottom line. Second, has the highest exposure to Greater China, so I think that DBS is in a good positioning to tap on the trade flows from China to ASEAN. And thirdly, price to book ratio is trading at a discount of 1.26 times, right? And dividend yield is still attractive and stable, 3.3 to 3.5%. So first of all, as you can see that the net interest margins have bottomed out, right? And the good thing is that they have stabilized over the last 3 quarters, right? So of course the interest rate environment is extremely depressed. So again, the loans growth momentum is much stronger than its peers. As a result of that, you can see that the net interest income is continually being driven by the exponential loans growth, right? And it outperforms its peers. So for QE tapering, right, it has kicked in. The effects, as you can see from the yield curves for SGD, right, yes, what the long-term interest rates as well as the short-term rates have widened, right? I think that the banks could take advantage of the widening spreads, and this should improve their interest income. On the other hand, for net interest margin recovery, we expect it to recover gradually in the short term, in the medium term, because the short-term rates most likely will only start moving in the medium term, right? Once the US Fed announces that that they will remove the cap on the short-term rates. Okay, so DBS stands to gain the most simply because it has a cheaper source of funding from its high CASA deposit ratio, which is current account, saving accounts. As you can see, about 60%, right, of total deposits, right? So it's in the best position to take advantage of rising short-term interest rates in the medium term. Okay. In terms of liquidity-wise, right, the 3 banks generally have been breaching all-time high loans-to-deposit ratio, right? However, DBS SGD balance sheet still remains very healthy, right? Much healthier than its peers actually, right? And for the second investment merit, DBS has the highest exposure to China. Their Hong Kong operations have been showing very healthy growth in terms of their profit before tax. This is partly driven, actually mostly driven by the strong trade loans growth, right, from the Hong Kong through Greater China side, right? And this gives them an edge as well over its peers. So for the general trend in terms of fees and commission, right, for Greater China, you see that DBS, right, much better position than its peers, driven by mainly the wealth management, trade-related and loans-related fees and commission, right? As a result of that, it outperforms its peers. Right, so this is the revenue split for DBS. Again, right, the Hong Kong and Greater China operations takes up a much larger proportion of revenue compared to UOB and OCBC. And for UOB and OCBC, right, there's a greater split of revenue coming from the ASEAN region, especially OCBC. Right, so we're a bit more cautious on ASEAN currently because of the political situations and Indonesia's outlook. Right, so DBS again should be in a better position than its peers. In terms of valuation, DBS, right, 1.26 times PB currently, trading at a discount to its peers, and the ROE profile is looking very attractive, about 11% currently, so it's on par with its peers, yet its valuation is much lower. So this forms our third investment merit. So some of the key risks for the Singapore banking sector, right? The share price is right in line with the STI. So yeah, this is one of the key risks, right? And for the rising interest rate environment, it might result in a worsening of credit quality. So we might see an increase in credit provisioning, loan loss provisioning, which might pull down the net income, right? Thirdly, the forex depreciation of the key currencies that the banks are holding, and lastly, the general weaker performance of the Asian economy. Right, some other drivers to look out for. Right, the global market sentiments are quite positive, so this might positively impact the fees and commission, and might improve the net trading income, which has been very volatile over the last year. And then for the QE tapering wise, okay, we might expect some losses on their long-term portfolios. Right, so the banks have been reducing exposure in terms of the aspect, and the tightening of liquidity might drive up the funding costs. Okay, yeah, but I think that the Singapore Bank should be able to mitigate this from their strong deposit franchise, especially DBS. For the regulatory changes, nothing much. Still finalizing on the liquidity coverage ratio under Basel III should have minimal impact on the banks. Lastly, again, a bit more cautious on ASEAN for FY14. Right, because the depreciation of currencies might impact their overseas subsidiaries. Right, as of all, concluding the DBS, on DBS, for investment merits, rising interest rates, DBS tends to benefit the most. Right, great exposure to China. Okay, price to book ratio trading at discount, and dividend yield stable at 3.3%. So we maintain our target price on $19.09 at 1.3 times forward price to book. Okay, so our rating is still at accumulate.
Hi, good morning everyone. We share with you our top pick for the O&M sector, Keppel Corp. We have a target price of $12.34 for Keppel Corp. Last trading price for Keppel Corp is at $10.68. As you can see, Keppel Corp has four main business segments. The most important one is offshore marine segment, which will be our main focus. It actually constitutes 58% of our revenue last year. Infrastructure, which is its gas and electricity business, which constitutes 28% of our revenue last year. Property, which mostly comes from its 55% stake in Keppel Land, as well as investments, which is pretty insignificant at this point of time. Here are our three investment merits for Keppel Corp. One is its resilient O&M margins expected over the next 2 years, coming from its jack-up rigs due to the efficiencies from repeated orders. Second, it's its strong order book wins. Keppel Corp, in fact, has secured $7.2 billion of orders last year, pushing its net order book to a record high. Thirdly, it's its attractive dividend yield of more than 4%. Let's go into further details on why we see the recent margins over the next 2 years. First is because of its higher concentration of its order book in a single product. In fact, Keppel has orders coming from various operators ordering the similar KFLB class jack-up rig design. And this should result in higher efficiency due to the repeated building of similar orders. In fact, out of 29 jack-up rigs that are secured up to date, 16 of them are based on Keppel's proprietary KFLB class rig design, as you can see on the diagram above. And if you look at the operating margins trend over the past 4 quarters,
Keppel has been achieving strong O&M margins over the past 1 year, and actually overall FY13 O&M margin is at 14.6%. The latest 4Q result also shows that operating margins remain robust, which is hovering above 14%, which is a healthy level as compared to Sembcorp Marine, which actually has a lower operating margin of around 10 to 12%. And we expect operating margin to remain resilient over the next 2 years due to repeated design of its KFL B-class jack-up rigs. Second, which is the strong order wins, we can see that the Keppel has secured $7.2 billion of order wins last year. This pushes its net order book to a record high of $14.2 billion as at the end of December 2013. According to management in its latest quarterly briefing last week, Keppel's management remains optimistic about the inquiries coming from both jack-up rigs as well as semi-submersible rigs. As you can see on the diagram above, utilization rate for ultra-deepwater rigs stays above 95%, very healthy level. This indicates that the rig supply remains tight. And according to Douglas Westwood, global investments in ultra-deepwater projects is expected to increase by more than 50% through 2015. So we should be able to expect ultra-deepwater orders to remain robust going forward. If we take a look at the oil prices, it's still hovering above $100 per barrel, which is also a healthy range. This should sustain rig order demand going forward. Investors may be concerned with the recent increase in Chinese competition. In fact, if you look at the diagram on the left, you can see that the market share from Chinese peers has been increasing over the past few years. This is mainly due to the lower pricing as well as the attractive payment terms that the Chinese peers offer to its clients. However, if we go deeper into the analysis, we can see that there are only 34% of the orders that actually secured by the Chinese peers actually came from established operators. Most of the contracts won by the Chinese yard, in fact, are actually coming from speculators as well as its domestic players and new entrants. So this actually poses some sort of like a risk to the Chinese peers. On the other hand, for established yards like Keppel Corp, they actually most of their orders actually comes from established operators. Due to Keppel's strong track record in executing the orders, delivering the rigs on time or even ahead of schedule. This has also allowed Keppel to secure orders at higher pricing. Currently, a normal KFL B-class jack-up rig is actually sold at around like $200 million per rig, despite the fierce competition from the Chinese peers. So all in all, in conclusion, we still see Keppel Corp as our top pick for our O&M sector. We have an accumulated rating for Keppel Corp, a target price of $12.34 based on some of the parts valuation. Three main investment merits for Keppel remains the resilient O&M margins over the next 2 years, coming from the repeated execution of its KFL B-class jack-up rigs. Second is its strong order book wins. Third is its respectable dividend yield of more than 4%. Right, so I'll pass the time to my colleague, Yong Kai, who will talk to you more on Iconics brand. Thank you.
Hey, hi, this is Yongkai here, the US equities analyst. Actually, 2 weeks ago, I already talked about Iconics Brand Group. I'm just reiterating today because this is our top pick for the consumer discretionary as we described earlier. So, okay, so share price actually hasn't changed much. Market cap $1.9 billion. Just a quick recap. What Iconics Brand Group does, it focuses solely on marketing, advertising, and licensing its portfolio of 33 consumer brands. Okay, so in all, they took out a total of $13 billion to global annual retail sales, which ranks this number 2 only after Disney. So it carries no inventory, so there's no operational risk. It doesn't have to worry about selling, sourcing, or warehousing under this business model. All this will be taken charge by the wholesaler or the retailer. All Iconics does is to collect royalties for lending out its brands. So as such, there's little need for working capital or capital expenditures. These are the brands, just some of the brands represented. You might be familiar with Umbro, OP, perhaps Echo, Lee Cooper, and Peanuts. So again, what are the key investment rates? We have 4 of them. Firstly, recurring high margin revenues. So they are contractually guaranteed a minimum if net sales target isn't met. As of 30th June 2013, there's $800+ million revenue that's contractually guaranteed minimum. This is actually more than double that of 2012 revenue and just slightly under twice that of 2013. For all this, they're only requiring 148 employees. So what this basically means is that each employee is in charge of generating $2.5 million revenue and more than $1 million free cash flow, which is nearly unheard of. Gross margins are really high, 100%, because there's no inventory. EBITDA margin is 64% and net is 35%. So previously, some of the those who attended our webinar asked, is there any comparable? The thing is that as far as we are aware, there's no pure play publicly traded. So as such, there is a lot of selling, general and administrative expenses that you have to decide how to allocate it, and it's not that clear. All right, but I mean, in any case, regardless, net margins of 35% and gross of 100% is very respectable. Capital allocation is very disciplined. So $1.9 billion on brand acquisitions is actually equivalent to today's market capitalization. So they also spend around $400+ million to repurchase 22% of outstanding shares for the whole of last year. So today's share price is 32% higher than the average purchase price. Customer demand is very good. Retailers can brand their merchandise. All they need to do is pay Iconics a 3% royalty. So because they are in charge of sourcing, they are in charge of merchandising, warehousing, inventory, so they get to earn very high private label like margins. Yeah, you can think of it as retailers hiring Iconics as an advertising firm to help the brand, to help to license out its brands, whereas the retailers take charge of everything else. Also, there's exclusive arrangements. So if you something that's found in Walmart will not be found anywhere else, not on Target, not on e-commerce. So this actually helps to avoid price comparison, or rather this phenomenon called showrooming. In the last 5 years, Iconics actually successfully branded $7 billion of annual sales. Okay, so this is roughly equivalent to more than half of today's annual retail sales. So they actually have 6 multi-billion-dollar brands, which they actually manage to renew every year because the retailers are very in high demand for it. Lastly, international growth. Revenue contribution used to be 6% in 2009, but today is 33%, and for 2014 they are projecting roughly 40%. How this works is Iconics forms all the 50-50 JVs. So you have in China, India, Canada, Europe, Latin America, and the newly formed Australia. Because they are JVs, so you won't see them as a revenue top-line contribution, but they will fall in under the equity income. As partners are all very reputable. In China, you have Silas Cho and family behind the revitalization of Tommy Hilfiger, as well as Michael Kors. So in 10 years from practically unknown to around 13-14 billion dollars market cap on NYSE. Then in India, you have Reliance Industries, and Latin America, you have Falit Group. So to quickly gloss through the historical financials again, if you remember, 2 weeks ago we went through this chart. So revenue has actually increased 5 times from 2006 to last year at a 28% CAGR. Similarly, free cash flow has increased from $45 million to roughly $207 million. That's also a nearly 5 times increase. Okay, most of this growth, although they came from acquisitions, but most of them are actually all the acquisitions are all very accretive, right? So as a result, free cash flow increased around 5 times, and the share price increased around 5-fold, 500% during this period as well. So this very high quality recurring free cash flow, which is around half of 2012 revenue, 51%, enables Iconics to pursue acquisitions or repurchase shares like what it has did last year. So the valuation hasn't changed. We're still looking at $45.44 fair value, which implies a 23% upside from today. Not that we are only factoring the 3% terminal growth, which is all organic, but every time it makes an acquisition, these are all accretive and adds tremendously to its earnings, and this isn't factored into this valuation model. So at 23% upside, we think that is a trading buy. Okay, next I'll pass this on to my colleague.
Hi, morning everyone. This is Colin, and I'll be sharing on M1, which is the topic for the telcos. Okay, this is just a snapshot of the company, right? Share price closed at $3.35 based on last Friday, the following 52-week range. Market cap is about 3 billion Singapore dollars, and the P is traded at about a P multiple of about 19.3 times, right? So following chart shows the historical 1-year performance, whereby M1 has actually outperformed the STI index. Okay, just a quick update on the FY13 results as well as the outlook for the following financial year. Net profit for FY13 was up 9.4% year on year at $160 million, and this is mainly driven by strong growth in mobile services. Service revenue was up about 6.3% year on year at at 819 million. Right. Also, special dividends of 7.1 cents per share was declared. Okay, that brings the total dividend per share to 21 cents for the whole of FY 2013. So that actually gives more than 6% dividend yield for the financial year. So other developments as M1 is continuing to grow its fiber and as well as its MeBot customer base, right? And if the take-up continues at a healthy level, you can expect the cross-carrier eligibility of the popular English Premier League by mid-2014 this year, right? Also, it has plans to enhance its current 4G network to the LTE Advanced by end 2014, so that will actually bring up the speed of up to 300 Mbps for the LTE Advanced, okay, which is about double of the speed of the current LTE network. So this will further spur data usage, which will eventually helps to facilitate the growth in mobile data revenue, right? So our outlook for 2014 is that higher mobile data revenue will continue to drive the growth in M1 earnings, and also we expect a moderate earnings growth outlook, which is in line with the management's outlook. Okay. This is just an overview on its revenue contribution. Main contribution mainly comes from mobile, which is about 61%, and that's higher than its peers, which are StarHub and Singtel. So that actually gives M1 more exposure to improving mobile data dynamics. Okay. Also, it's continuing to grow its fixed service segment. on fiber broadband as M1 continues to grow its broadband customer base from a low base. Okay. Also, yes, recently rolled out its new development of its internet TV offering, which is a Mi Box, so that we actually able to grant it the popular English Premier League contents if it able to achieve the target of 10,000 customer base, right? Which is expected in the middle of this year, right? So just a recap on its growth strategy on how M1 benefits from more data monetization, right? In September 2012, there was a revision on its post-paid mobile plans to the tiered data plans. So as you can see on the chart below, previously the plans were generally sharing a 12 gigabyte data bundle, but however that has been revised to a tiered plan, okay, with the basic plan of the value surf plus having a low data bundle of 2 gigabyte, right? So access data charges was charged at about $5.35 per gigabyte, and also the growth strategy is also facilitated by the high smartphone penetration in Singapore, which is about 78%, as smartphone users are generally the subscribers that generates a huge amount of mobile data. So on how is mobile revenue is being driven, right? Right now, as of December 2013, the average monthly data usage per smartphone user was about 2.5 gigabyte per month. So that was actually up from 2.1 gigabyte per month a year ago, and do note that the average monthly data usage is actually higher than the lowest data bundle of 2 gigabyte. So some of the key drivers that spurs the data usage is due to the take-up of 4G, as 4G offers a faster speed, about 3 to 4 times as compared to 3G. So that would mean that most subscribers are able to surf more web pages and also on contents within the same time frame. So that actually leads to higher data usage. Also due to changing social habits, as more subscribers are utilizing their application of social media messaging and also streaming of video on their mobile phones rather than their desktop computers. So that's another driver that leads to the higher data usage. So all these will eventually lead to more subscribers exceeding the data bundle, and that will lead to increasing mobile data revenue for the telcos. Okay, M1 is also having a good traction on its how data monetizing, as the adoption of 4G tiered plans right now is about 49% of its postpaid customers. So this was up from 14% as compared to FY 2012. So as you can see, in the last recent quarters, okay, mobile postpaid ARPU has actually rose year on year, right, with the current level at about $54. So right now, of these tiered data plans, about 16% of its tiered plan customers have actually exceeded their data allowance, right? So the excess data charges, also note that M1 has actually doubled its excess data charges with effect from beginning of this year, 1st January 2014, from $5.35 per gigabyte to $10.70 per gigabyte. So this we are optimistic on further ARPU uplift, right, for the FY14 due to on higher mobile data revenue. Okay. Some other areas to note that acquisition costs per postpaid subscriber is slowly creeping down. Based on for the average for FY 2013 is about $343. So this is low as compared to the average amount of 369 in FY 2012, as this is mainly due to the attractiveness of a smartphone. So hence the telcos would incur less on the advertising and promotion spending to attract new subscribers from renewing their contracts. Okay, M1 also continues to grow its fiber broadband customer base. Right now, the broadband customer base about 85,000. This is higher as compared to 52,000 a year ago. So right, and it's current as of September 2013. This resident broadband market share is about 6%. So this also leads to high fixed growth in its fixed services revenue, which was at 61 million, which was up from 48 million in FY 2012. Also, capex for the current financial year is guided around 130 million. So this will be similar level as compared to the capex in FY 2013. Right. So to sum up on the investment merits for M1, M1 stands to benefit most than its peers from mobile data monetizing, and fiber continues to add growth to its earnings as M1 continues to grow its broadband customer base from a low base. Okay, M1 also offers an attractive dividend yield of more than 4%. So we are giving accumulate recommendation with a target price of $3.68, which implies the forward P multiple of about 20 times. So the total upside potential, with including dividends, will be more than about 14%. Right. So next, I'll hand to my colleague.
Hi everyone. Okay, let's talk about Baostat Singapore. Okay, so for Baostat Singapore, we've been up 32% since initiation last year, and we still expect additional 22% from the current price. So our target price as of now is actually $2.05. The current price of Baostat is around 160 something right now. Okay, so we think there are plenty of catalysts ahead. Okay, so the recent data from Baostat is such that the first half FY 13-14 it's not great, but we still have catalysts ahead. Okay, so to recap, Baostat has essentially 4 major divisions, right? It's got the energy engineering division, which actually only 4 players globally in the direct fight heat processing. There are only 4 players in direct fight heat processing globally. Okay, and this is actually the heart of the refining business. So this is actually quite a good business. We have the industrial design and build. Okay, and only 3 players regionally have full turnkey capability from architecture, conceptualization, industrial design, construction, project management, and TOP. Okay, the water treatment division is highly competitive. It's not making much money at all. Neither is it losing money. Okay, the geospatial technology is a great business. Okay, it has exclusive rights in Australia, Singapore, Indonesia, Malaysia, to Esri's globally dominant geospatial technology. Okay, and it's got 60% global market share. Okay, for governments, and 40% governments if you include the privates as well. Okay. Okay. Let's continue. Okay, so what are the catalysts ahead? Okay, we have a record high order book, okay, and that will drive better earnings next, financial year. There's also an additional 600 square meters of industrial portfolio space that's being developed, and this will actually boost recurring income. Okay, there's an additional 120k square meters of industrial land, okay, in Iskandar, Malaysia, in which Baostat owns 35% in this joint venture. Okay, now because Baostat has high free cash flow generation and a net cash position as well, there's actually a lot of firepower to ramp up further. Okay, so we think that Baostat is actually steeply undervalued, the catalysts above. Okay. Okay, so this slide shows you basically that the record high order books this year will actually drive next year's earnings. Okay, so as you can see over here, the order books are a record high. So we think that this will actually drive next year's earnings. Okay, in addition, we have the 600 square meters of industrial portfolio, and this could bring PBT contribution, okay, from 15.3 million this year forecasted to actually 26.9 million, okay, by FY16. Okay. And some more, the portfolio is to be, about 160 square meters, and that's about 71% the size to REIT. Okay, so I think Boston is in the process of trying to REIT their properties, and they're basically almost there. So not only will there be a PBT contribution, but there's a potential of REITing as well to unlock value. Okay, for their Iskandar JV, okay, it's going to be here in the Nusajaya. So the 1,200 square meters of industrial land, okay, which 35% is actually by Baostead, 35% is AME, 25% is a Tat Hong Family Office, 5% is CSC, which is also affiliated to Tat Hong. Okay, so this is the region here, and this is where this land is going to be developed industrially. Now, this is actually quite a good piece of land because this particular land, right, is a limited industrial supply land, okay, in an area well known for living, Horizon Hills, Marlborough College, etc., and playing as well. You have Legoland and Hello Kitty, okay. So being close to this region, right, bodes well. Okay, Malaysia also has no formal plot ratio policy, so developments here can actually be very creative, can be very tall. So there's a lot of potential value to be unlocked here on this good piece of land. Okay, Baostead, as you can see, actually has very good free cash flow. Okay, free cash flow to firm has been very strong. Okay. Okay, so net cash of 21.9 million. Okay, plus high free cash flow generation. Okay, basically gives them opportunity for more industrial property deals and more developments to come. And the closer we get to and the higher this goes, the closer the probability there is to unlock all that value. Okay, now how do we value this? Okay, the market cap is basically 865 million. Okay, as of last price. Okay, which is 168. Okay, and 515 million shares outstanding. Okay, so if you take this market cap and we less off the net cash of 225, Baostead is a net cash company, right? And if you less off the property valuation of 238. Now this property valuation, right, it does not even count the full 160k square meters by FY16, okay? It just counts the properties that are only going to be operational in this year, FY14. So if you take out from the market cap, you take off the net cash, if you take off the property valuation, okay, that means that the rest of its parts, the energy engineering, the design and build, and geospatial divisions is valued at just 402 million, okay, for their combined 58.2 million of their after-tax earnings, which basically means a 6.9 times PE. So we think that's basically too cheap for such quality engineering divisions. Okay, and some more, a listing of the industrial portfolio, which is worth 419 million, okay, by FY16 may be a way to actually unlock this value over here. Okay. So here's just summary about it again. All right, you can see that the target price is 205 from a present price of $1.68. Okay, and that concludes today's webinar. So we will now welcome questions for any of our analysts regarding the stocks talked about today. DBS toppers.
There's a question on Sam Marine. Currently, our take on Sam Marine is neutral. We believe that there are still ongoing concerns with regards to its Brazilian yards because of the fact that this Brazilian yard is pretty new. They prior to that, they don't really have any experience building rigs in Brazil yet, as compared to its peers, Singapore peers, Keppel Corp, which has more than 10 years of experience in Brazil itself. So probably that's why we see that's probably the reason why Sembcorp Marine has been down recently.
Hi, Benjamin here. Got quite a couple of questions. Number one, is DBS and OCBC Bank a defensive stock? In general, the banking sector is not a defensive sector, yeah. So it rides on a recurring economy, so it's more cyclical, right? And then the second question is on DBS. This question on what about OCBC if interest rates rise? Okay, across the banking sector, yes. If the short-term interest rates do move up, or even long-term interest rates, the banks will be able to take advantage of it. It's just that DBS, in comparison, tends to benefit the most, right? Simply because of the fact that its cost base is lower, right? If you examine the current accounts and saving accounts balances, as well as the SGD balance sheet, right? If you compare that, that's where we can see the difference, where DBS has a competitive advantage against its peers. All right. Next one, our view on OCBC buying Wing Hang Bank. Is that a good thing? Yes. All right. So it's quite a lot of news currently if you've been following over this. So as of last Friday, they just announced that they are pushing back the finalization till March, right? Because they are still pending some of the approvals from the Hong Kong regulators, right? Our thoughts is mostly whether it's good or not, right, really depends on how much they're paying for it. Currently, Bloomberg has reported that the deal might be valued about 1.9 times PB. So assuming it's 1.9 times PB, right, based on our assumptions, we feel that is quite a large premium to pay for a medium-sized bank in Hong Kong, considering that the ROE profile is less superior to OCBC itself, right? Now, for the half year FY13, right, for Wing Hang Bank, the ROE is about 10%, with currently this PB is trading at about 1.74 times, right, compared to OCBC's own ROE profile, which is about 11%, and its price to book is about 1.49 currently, right? So we can see that from that comparison, right, it's a bit overpriced. Yet, if you examine it on a relative basis, okay, for Wing Hang Bank, is still at 1.9 PB, is still slightly cheaper than the previous medium-sized banks that were sold, like Chong Hing, right, and Wing Long Bank, which were both acquired about 2.1 to 2.8 times PB, right? But the argument is, of course, that in the long run, it fits into OCBC's strategy of breaking into Hong Kong. Okay, but in the short run wise, short to medium term, right, what we are very cautious about is that it might prove to be dilutive to shareholders, right? Because to finance the deal, right, we expect that UOB might do some form of rights placement, right, so that it will not impact their capital ratios, right? So because of that, right, we feel that will be, definitely will be dilutive to the EPS, right, and might destroy shareholders' value, right, by paying the premium. Okay, entry price for DBS, nope, do not have that. Okay. Okay, so that's all about from me, Benjamin. Thanks.
Hi. Ken here. Okay, question on what is the support level for the STI? Okay, so the immediate support levels for the STI are 3,000. Okay, if 3,000 is broken, you have 29.30. Okay, so 3,000, 29.30, and following that 28.60. Okay, so the immediate support levels for the STI is 3,000, 29.30, and 28.60. Okay, next question. If I have a long-term view, 5 years, is buying Boston at today's price of 164 a good buy? If you have that long-term horizon, then the answer is yes, because our fundamental valuation of Boston is worth $2 plus. Okay, so yes, for a long-term basis, it will probably be worth more than 164. What is a good okay? Next question is, what is a good entry price for Boston? Okay, so for Boston, we gave a fundamental target price of $2 plus, $2.05. So this is a fundamental target price. Now, but if you ask me as a trader, what's a good entry price of Boston? I will say that if the $1.60 price is broken, then 150 is actually a good time to get in. I will say that $1.50 would be optimal place as long as all the catalysts for Boston are still valid. Then 150 is a good time to get in. But if you have a long-term outlook for Boston, then even now is a good time. Next question. The Dow and S&P both fell below the MAs. Okay, is it a sign of US on a downtrend correction looming? Well, I mean, if you looked at our guidance in mid-December and last week, I already mentioned that there's probably going to be a correction by February. So we are just basically a few days before February, and we've corrected. I expected it to be a correction in February and probably another correction sometime in May. Okay, so yes, we are correcting, but we do believe that we are correcting within a bull market. So I don't think this correction is a starting of a bear market. The only question is just simply how far this correction is going to be. And when we have more guidance on that, we'll let you know. I got one question here about Boston. Don't you think investment in the REIT and JV in Iskandar will reduce its cash position? Okay, the area is over. Okay, well, the thing is, Boston is not investing in a REIT. Boston is trying to REIT off their investment properties, which will basically unlock a whole lot of cash for them. Okay, so the thing is, their investment in the JV Iskandar actually bodes well, because if they can successfully do that, they will basically be increasing their industrial portfolio. Once the industrial portfolio reaches a certain size, a listing of this industrial portfolio as a REIT could unlock all that value and release all that cash. Okay. Yep. I said net cash. I didn't say zero debt. Sorry, for Ballstead, right? I just want to reiterate. Clarify one thing. Ballstead has a net cash position. Okay, doesn't mean it's got absolutely zero debt, but it has a net cash position. That means cash minus debt is positive. There's a lot of capital questions. Did you answer it?
Hi, there's a question on Keppel Corp regarding the dealership. Well, we are not very concerned on this front, given the fact that Keppel's strategy in a near market, near customer. We believe that Keppel will be able to build a drill ship that is well customized to its customers' needs. And this is also a good strategy because of the fact that current yards are actually coming in with jackup rigs as well as semi-sub orders. So this is a counter attack for Keppel Corp to actually get back some order wins from the Korean yards as well. The fact that they are building the drill ship without a firm contract is also because typically the first order is hard to get. It's hard to negotiate because no one actually get to see the product itself. But we are pretty, but we are not very concerned with that. And also, drill ship usually takes about 3 years to complete, and accounting management, they will be starting to market by next year, which in fact will shorten the wait for the wait for customers. So in a sense, it should fetch a higher pricing, a better pricing in fact. With regards to the property segment for Keppel, because of the fact that only about 17% of Keppel's revenue comes from its property segment, we see that this should not be a concern to Keppel. Most of its revenue still comes from the O&M sector, which is the main driver of Keppel Corp's earnings. So all in all, we remain positive on the Keppel Corp with a accumulated rating and a target price of 12.34. Thank you. All right. Thank you guys for logging in today. We shall see you next week. We'll be presenting on initiation on First Resources next week. So hope to see you tomorrow. Next week. Thank you.